which entered into the financial markets probably in the last 40 years after 1970 itself. But today we see that there is a lot of craze that goes behind the derivatives market. There's a lot of volume that goes into the derivatives market. Number of participants who are playing in the derivatives market is extremely high, and today it is becoming one of the most important branches in the world of trading. Almost every financial institution gets into the derivatives trading. Every bank is playing in the derivatives market. So almost every financial institution, or at the same time there are so many new financial instruments that are getting created using the concept of derivatives. So that's one of the prime reasons every one of us need to have a comfortable understanding to the world of derivatives, right? And as we have been observing over the past couple of decades, that the derivative trading happens in two ways. One is over the exchanges, where wide varieties of products, especially products like futures and options, they are traded widely across various exchanges over the world, and at the same time some kind of derivatives are traded over the counter. Over the counter is more like between the two parties. So here we see some kind of derivative products like forwards, swaps, and even some kind of options are also traded in the over the counter market. And today there is a huge trading across almost all the exchanges for futures and options. There are lots and lots of high volume, high valued contracts that are happening in the over the counter market with respect to forward swaps and different other kinds of options. And everyone, financial institutions, or probably the fund managers, and every other participant is looking forward for some kind of investment or the other with respect to the derivatives opportunity, derivatives market. And on the other side, derivatives are getting packaged. We have observed that today derivatives are getting packaged into various other products, like they are packaged with bonds and called as bonds with embedded options. Typically we hear the words like callable bond, convertible bond. It's as good as a derivative being packaged with respect to those bonds. Or probably we look at with respect to the compensations of the employees, a derivative instruments being packaged into the compensation, employee stock options, ESOPs. Or sometimes we are seeing that the derivatives are packaged along with the investment decisions, wherein the world of real options have come up. So what we are seeing here is the concept of derivative is getting packaged with various other financial instruments also, which means the more we understand the world of derivatives, the more we can try to understand even the products which have packaged them, and probably take our decisions quite effectively in the financial space. So with that as the base, I just want to give a brief introduction of the derivative. We all know a basic definition. Its value is derived from some underlying asset. So which means it's not something in isolation. the value of this particular derivative instrument is derived from the value of some underlying asset. Probably if I say derivative on Infosys stock. So whatever is the derivative product which I am creating, the value of this derivative, the value of this derivative will change in line with the stock price of Infosys. So this is not something in isolation. So its price is always based on the underlying asset. This underlying asset today can be almost anything. It can be stock, it can be bond, it can be a stock index, it can be a currency, it could be an interest rate, it could be almost anything. And today, not just, or it could be a commodity. So, based on the price of these things, the value of the derivative is getting derived. But not just limited to this. Probably I can create a derivative instrument, let's say based on the weather. If the temperature on a particular day is more than something or less than something, I'm going to pay you something. If it is the other way, you have to pay me something. So the derivatives are something like that, right? Wherein the payment, wherein the agreements are coming up in terms of paying or receiving some amount based on the futuristic movements of the price or the value of any other underlying products or assets. So that's how the derivative market started growing up. Today, apart from these regular instruments, we are seeing heavy kind of a trading happening in the world of credit derivatives. We are seeing heavy kind of a trading that is happening with respect to weather derivatives, wherein weather is the underlying. So it's as good as the example which I have specified. If it is going to rain tomorrow, then probably I'm going to pay you some X. If it is not going to rain, then you have to pay me some Y. Such kind of agreements can come out. So there are weather related, there are electricity related derivatives that are getting traded, and probably there are more traditional ones in terms of equity derivatives, the foreign exchange derivatives, the interest rate related derivatives. We find so many such kind of active markets associated with various derivative instruments. So there is a huge opportunity to make extraordinary careers in the world of derivatives, provided the understanding of the derivatives market, the valuation of the various derivative securities gets completely clear for us. And so in this context, getting started with the two types of markets as I have specified earlier, there is an exchange traded market and there is an over the counter market. So when I am talking about an exchange traded, it is more like any other stock market. There is a physical exchange that is existing, and this exchange will set the rules of the trades. Exchange will set the rules of the trade, because here the rule is as simple as, okay, you are going to buy or sell something, not today, but at some future date. See, most of the derivative contracts are like agreements, right? Most of the derivative contracts are agreements to buy or sell some asset at a future date, not today, at a future date, for a price that is agreed today. So what we are saying is, what to buy, what to sell, when to buy, when to sell. Those kind of rules are what to buy, what to sell, when to buy, when to sell, how much quantity to buy, how much quantity to sell. These kind of rules relating to the trade are set by the exchange. That's the reason we say the exchange based contracts are all standardized contracts, because all quality, quantity, the date, all of them are specified by the exchange itself. So though the concept has been there for quite some time, the active trading has been done in these kind of markets only in the last 40 to 50 years. And the standardization can happen in terms of any of the assets. Again, as I discussed earlier, it could be equity, it could be a currency, or it could be interest rates, or many other kind of underlying assets. And generally in the exchange, earlier there used to be what is called as open outcry process, which means people generally meet up on the floor of the exchange, they shout or use some kind of gestures to indicate the trades that they want to execute. So this is like a physical vegetable market where you shout out the price of the vegetable, and someone who is interested in it, he goes there and tries to purchase it. So here also we are talking of a similar kind of a concept where people physically meet on the floor of the exchange. They try to use various signals and mechanisms to indicate their interest in terms of buying or selling something, and they get their trades executed. But slowly this open outcry process in the exchanges is giving way to electronic trading, wherein we are talking about the traders actually not meeting physically, but they are meeting virtually on the computer. They enter their desired trades on the computer, and computer